Look, everyone knows the Fed and central banks jump in with their usual tricks when the market starts gasping for air. They cut rates, pump money, promise they've got it all under control. But here's the harsh truth. Monetary policy alone doesn't save us. Not anymore. It hasn't for a while. If you're sitting there thinking they'll fix the next crash like before, you're already behind. The system's changes, the global economy's complexity, monetary moves are just band-aids on a bullet wound. What fuels economic crashes today are problems way deeper than interest rates or bond buying. We're talking about global debt mountains that central banks can't just erase. We're talking about supply chains shattered by geopolitical storms, inflation fed by more than loose money, actual shortages, energy crises, political chaos. Think about your portfolio right now. Holding on to old bets because you believe in a typical cycle, that's how you get blindsided. Monetary policy doesn't work in isolation. It's reactive, slow, and often behind the curve. Don't get angry with it. Get relentless in adapting beyond it. What needs to happen? First, stop relying on central bankers to hand you the solution. This is your fight, your move. Diversify like your life depends on it, because it does. Look beyond traditional asset classes. Real assets, alternative debt, emerging markets that no one else touches. Don't just follow the herd into stocks and bonds expecting safety. That's a trap. Next, understand interest rate policies, but don't worship them. They're signals, not gospel. When rates go down, don't just buy stocks. Hunt the underlying causes. Why are rates low? What risk is piling under the surface? You need to get comfortable with discomfort. That means stress testing your investments against scenarios nobody else is thinking about. Think about technological disruptions, climate events, political crack-ups, because those will punch holes in the best-laid monetary plans. Build for resilience, not just growth. And here's the brutal part. The easy fixes central banks offer actually create bigger problems later. Low rates for too long fuel asset bubbles. When they burst, everyone feels the sting. If you're not positioning yourself to ride out that sting, you will lose. So protect your downside with conviction. Real liquidity cushions, hedges that work when everything falls apart, assets uncorrelated with standard markets. Ignore this and expect chaos. The frustration of watching markets tank while policymakers do their routine safe dance? Stop wasting energy blaming them. Direct that rage at how you're preparing or failing to prepare for what's coming. Also, don't get caught dreaming that inflation will just vanish with rate hikes. Inflation today is sticky because supply chain issues and politics are tangled with money printing. This isn't a textbook cycle anymore. Adjust your portfolio strategies not just for nominal returns, but for purchasing power preservation. Inflation erodes everything. Cash is poison. Bonds, risky. Your best bet? Real assets that produce income and can adjust prices. Look for misunderstood sectors and innovative ventures creating value independent of central bank actions. Find pockets of growth where these policies don't reach. Most importantly, connect with the right minds. If you're solo in this, you're vulnerable. Align with other serious founders, investors, operators who get that this game isn't about luck or comfort. It's war, a fight for your future, your capital, your freedom. Build networks that deliver real insights, real support beyond headline news, because that's how you survive and thrive when the storm hits. Stop asking if monetary policy alone can save the next crash. It won't. That's not a question for passives. It's a call to the engaged. So get aggressive in your strategy, brutal in your risk management, and relentless in building your own safety net. The next crash won't wait for anyone. You either act now with eyes wide open or get consumed when the system stumbles. No excuses, no shortcuts. Time's up. Subscribe to our YouTube channel and open the featured link to learn more.